Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Victor Bell. Victor has transacted over $59 million in real estate transactions in 7 states, including Hawaii, Arizona, Texas, North Carolina, Ohio, and Michigan. And in just a minute, we're going to speak with Victor about how to succeed in real estate in 2023. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Victor Bell. Welcome to CRE PN Radio.
Hey, thanks so much for having me today. I really appreciate it.
Well, I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure, definitely. I got started in real estate in the mid to late 90s. I like to tell people I didn't really know exactly what I was doing. I left home pretty young, got kicked out of high school, went back to high school, joined the military, left there. Dropped out of college that first semester. And they said if I came back, I was going to owe them money off of the free Army money. And then, got in trouble, was on probation, had to get a job. And then while at that job, though, I started recognizing the people who had been there for a really long time hated their job. And the people who were new, like me, also hated working there. Not that it was a bad job, but it was just the trap, right? It's the 9-to-5 trap, which a lot of people have, that experience. So, I was driving home one night, I worked nights, fell asleep while I was driving, ended up on the side of the road. And I was like, okay, there has to be more to, what's going on than this. So next day I drove into Austin. I was in Killeen, Texas. I drove in Austin, got a book from the store. And that first year I did $1.2 million in real estate deals. I didn't know what I was doing, so it wasn't like I was brilliant, but, I knew that was the route that I was going to take from then on. I've had a few sparse jobs. I had to kind of keep things going during that time frame, but primarily I've done real estate full time the whole time. So that's the background on me. And again, I got started from a book. I hurt my way through it. I met a lot of good people who pointed me in the right direction, so that's my background. That's how I've done this over the years. But I'm a regular guy like everyone else, pushing through the experience of investing.
Oh, I love it. I got to ask you, what was the book?
It was actually Fast Cash with Real Estate by Ron LeGrand. That was the first book. And again, it's a dated book from the 90s. But I literally, I'm a guy that if you tell me what to do, I'll just go do it. So I just as is that book, meaning the book says do this, I do that. So I pretty much cold called numbers out of the phone book, reading the script that was exactly in that book, and I ended up getting a deal. And then the book said also cold call mortgage companies and lenders and things like that and find money. I didn't know what that meant, but I was cold calling out of the phone book, and I eventually got somebody, Bob and Jamie, they owned a mortgage company at the time, and to even take my phone call. They were like, "How'd you even get this number?" I was like, I've been cold calling like the book says, and they invited me into the office and they're like, "Hey, let me, you don't even know what you're doing. Let me show you." So they kind of walked me through, finance and how to get certain things done. They actually became my first partner, and actually Jamie is my investor relations manager in our real estate fund. So just ironically worked out that way. Yeah, but that was how it started. And it's crazy because it's been a wild ride, and at the time, real estate cycles, market cycles, all that stuff, I didn't know. If something bad was happening, I just thought it was happening to me personally. Uh now now looking back, I was like, oh, that was happening to everybody. But but that's the start.
No, I love it. I love it. So were you, as far as the start, was it primarily calling on distressed single family stuff? Was that kind of the focus, or what was the?
Well, what happened was the number in the phone book. Now the number on the property was a single family house in the newspaper. And then, when I was talking to Bob, he's like, hey, call them back, find out if they have more properties that they're interested in selling. So I did, because they were like, yeah, we're interested in selling. Come down to the Exxon. They owned a bunch of stuff. I didn't know that. And turns out they were like, yeah, we have more properties. How much can you handle? And that's how I got that portfolio of deals. So ironically, though, in that portfolio of properties that we got, the rest of those deals were all multifamily. They were duplexes, triplexes, fourplexes. It was like a 16 unit, a 12. The one house that was in there, and be honest with you, which, forged my investment thesis for the future, was like, we don't do fixer-uppers, because that one house out of all those properties was the nightmare. Everything else was rented. They had tenants, and I had to learn a lot about, now being a landlord and maintaining and being a manager and things like that. But by the time we got rid of that house very quickly. So I learned a lesson. I have a huge appreciation for people who go in and fix stuff. Even the single family investments that we do, they're typically creative financing subject twos outside of the fund. They're pretty houses. I tend to focus primarily on really nice houses, really great locations, don't need a lot of renovations, no more than maybe paint and flooring, worst case scenario, if that. But the same with our multifamily selection. I like nicer apartment buildings, better locations, fully occupied, very little to do with them other than invest, and raise the rents here and there, but that's it. No heavy fixer uppers. But to your question, yeah, that was how that worked. Very little single family, but I have done quite a few single family, but they're de-risked.
No, I love it. I love it. Everybody's got their start, and like you were, relaying here. There's a lot of lessons that you learn as you go, and hopefully none of them are big enough to, sink your dreams. But there's a lot of battle stories and war stories that everybody can tell, and it's all part of the education. So that's great.
It is.
So you started off, you said the mid-90s, mid to late 90s, this is when you got started.
Yes.
And so was it in that first year then you ran into this portfolio opportunity?
Yes. Yeah.
And of that portfolio, you mentioned you sold the house right away. Did you retain any of the other properties, or have you since?
Yeah. So we kept all the other properties for a while. I had a partner in those deals, and we eventually sold those off.
Got it. And today, what is your the asset class of choice, and what's your model?
Right now we have a real estate fund. It's a $50 million fund, accredited. It's a 506C. That's for multifamily, B-class properties, B locations here in San Diego County. That's the target. We're still pushing out that capital raise phase because of what's going on in the market. So we've been highly focused, on that piece right now. And we do small properties, like, residential stuff, small multifamily. We picked up a couple of properties in Hawaii since we've been here and turned around and resold those. But again, that was just like, hey, this is not fund related. We're building the fund here. And, again, because I do this full time, and if I pick up a deal here or two from a side business for myself, those deals still happen. But the strategy remains the same. It's like pretty houses subject to creative financing, take the risk out for me, my investors, if we can get those, while we build capital on this side to go after the 80, 120 to 200 unit deals. Now we're looking at those for the portfolio, for the fund, that way our investors have a better size of deal based on the scale, because it kind of takes the risk away for them looking at something smaller. Hey, Vic, let's partner on this 20, 30 unit deal over here versus something that we can all take a part of, and I'm sure you probably get that too, being in the business that you're in. It does limit the risk. There's always risk. But it minimizes the risk when you can kind of go bigger and you're collectively doing it with other people, with somebody who has some experience.
Yeah. Oh, amen to that. Definitely more doors and spread the risk around. That's a good strategy.
Yeah.
So you've been doing this for a while now,
Uh-huh.
and I was talking with somebody the other day, and basically he was saying, "Man, if you couldn't make money in real estate in the last 10 years, this ain't for you." Just based on how easy it's been, as
Yeah.
far as with low interest rates and demand and just capital chasing return.
Mhm.
So you started the mid 90s. We're in 2023 right now. The last 10 years have been pretty outstanding. In fact, I know I started this podcast back in 2015, and I can remember one of the first interviews I did. The guy was saying, "Yeah, it's a question: are we in the ninth inning, or is this a double header?"
Right.
Kind of thing as far as the cycle goes. So obviously, the interest rates have changed quite a bit here in the last year.
Yes.
Um, what what are your thoughts? How are you approaching the marketplace given the change in interest rates?
Uh, very selectively. So, because again, in multifamily, I'm sure, from a commercial perspective, I don't know from the listeners to what magnitude, but it's all based on its income from one perspective. But that the market capital, the capital changes, interest rates have risen, things like that. As a matter of fact, I think from December till now, at some point last December till this year, they've almost tripled, because they were like 2.75 and, they're 6.7, like they've ranged across the gambit. Well, what that does is it forces people to look at the revenue of the property, the debt service ratio, and all that other stuff. That the 1.25 that banks want to see, or 1.27 in multifamily, you can't hit that. Your asking price has to come down, or which is the other alternative that people hate to hear, is you got to put down more money. So, some of the deals we looked at, when we underwrote them, we were underwrote putting 40% down. In California, Hawaii, they're higher price markets. So I mean the down payment needs to be more to hit those numbers. We looked at a deal and when we got the underwriting back from the potential lender on the debt side, they were sizing up the loan. It was like a 65% down to make that deal work. And we were like, whoa, who's going to do that? so not that it was a bad deal, because the whole part about it was, to your point, nothing changed. The market changed around it. There's a huge correction with that, with the cost of capital. That makes guys like me go, you know what, let's pull back, let's put the pencils down for what we're underwriting, and let's just focus on the capital part. So when we get an opportunity for someone who maybe they're a fund manager and they have portfolios that they need to kind of look and I'm sure they'll write down the portfolio and say, let's get rid of these assets that wouldn't have normally come to market because they've had to write down the values based on current, or a syndicator who got in 2 years ago, executed their value add plan. They promised their investors they were going to give them, some huge pref return as well as, some massive upside, and they go to refinance and they didn't pressure test what it would look like. Had their rate not went past 5.75, now it's 6.75, whatever it is that they have to exit on or refinance on, they can't. So that's been something that we've looked at. One, put the pencils down, raise the capital. And then if an opportunity presents itself because someone has to exit based on their timeline, maybe not because they want to sell, because they have to, we can take advantage of that. So that's what we're doing different. That's what we see in the market. And I have a theory. I've been saying it because I've saw it happen in Hawaii quite a bit. If people don't start investing with a syndicator and or fund manager who understands what they're doing and start collectively investing with other people, they won't have opportunity to get some of the better deals that they saw, to your point, because they've been played over the last 10 years, primarily really over the last 5. So that said, somebody who's just sitting on that old strategy of, find it, fix it, sell it, as multifamily commercial deals, things like that, they're going to have to change strategy. And within the changing of that strategy is going to come through collaboration with other investors.
Yeah.
That's my thought.
No, it's interesting. You mentioned that, obviously commercial debt is structured differently than, single family residential, where you can, get 30-year terms. Most of it has some sort of a sunset, somewhere between 5 and 10 years is what I think most have.
Yep.
I think there are some programs I know that go out further, but there's a natural date, an end, or a reset date, and it's going to present some opportunities based on just whether the investors are done with it because they haven't been able to return the capital that the investors were expecting, or they're just they're ready to let go of it, or just they want to sell, and but the price is a little different than what they had planned for an exit. And are you seeing prices? Are they are the sellers reflecting, or have they adjusted to the market yet, or are you still seeing that everybody's still trying to get the higher price?
Um, it feels like a standoff right now. So sellers aren't really dropping their prices and buyers aren't really raising their offers. So I think there's a middle ground of that's going to change. I think we have probably about a 12 to 18 month window opportunity that something is going to shake out. Somebody, like I said, if you have a bigger group, you have some of the larger apartment building groups that own stuff, and or the Blackstones and KKRs and things like that do have assets that they've held on to, that have a horizon. So they promise their investors above them 5 years, we're going to turn and burn this thing out, and they have to sell. Those are going to be the deals. But to my point, if you're a smaller person, if you're like, hey, I got money in an IRA, I'm accredited, but I have a business to run and I don't have time to learn this game. Those are the deals that you'll miss because you can't grab those deals by themselves. And I'm sure you probably see it in your area too. You have these bigger deals that are trading, and they're still trading at 4.5 caps, fours, some point 3.75, but they're better quality assets. They're institutional. And I think now is the time for the everyday investors to actually get access to those type of deals when we would have never been able to, because their timeline, the debt is forcing those people to come out of those deals, not the seller doesn't want to sell them. So, the owner groups don't want to. So I think that's really going to be the opportunity. So that's what I'm seeing in my market. The prices aren't changing, but the level of person that still will buy those properties, even at that current, we'll just use cap rates because everyone talks cap rates. Even somebody who's looking at a 4 cap deal, that's a great location, great asset, it is cash flowing, has the wherewithal to take down a 4 cap deal and it not hurt their returns, because they're like, hey, if we get 4, we're fine. We just want this asset. We want this location. We're not going to lose our capital here because we have responsibility to all of the capital that we're investing for our investors. So that's why I also made the move too. I was like, what has everyone been doing? I saw this happen in Hawaii. California is 10 years behind the Hawaii market from what I saw. And I wish I would have bought more property then. I even tried to buy some of my old apartment buildings back since I've been here, and I couldn't get them, even at today's price with them, almost $500,000 or $600,000 more than I sold them for, and I'm like, I wish I can get them. It's still a good price because rents have gone up. So that's what's happening, that make people still say, you know what, how does that even make sense? Well, rents still make sense because we're really buying the housing. We're not buying real estate anymore. So, he who controls the housing in the market wins. And that's kind of what it's turned into be.
Yeah, it's interesting. I'm sure there's the math makes sense. I haven't sat down and kind of worked through the numbers, but if with lower interest rates, more affordable debt, even with lower cap rates, for a long time, you could still get into a deal with 20 or 25% down. Are you seeing the returns? What are the returns that you're able to, figure out if you're coming in with a 60 or 65% down? Are the returns muted from where they were, or are you able to continue to get comparable returns?
Well, we won't do that. That's 65% down. We're sticking to the 40, 45%, which still makes our offers where they would have normally been at the better debt rate, right? So whether that'll be accepted or not remains to be seen, which is why I said we'd wait it out for the right property. But we do the returns pencil for the investors? Yeah, because we're not over promising our investors some ridiculous, and that's the problem. People, hey, we're going to give you guys a 8 pref, plus 20%, 40%, or 70% of the deal. So we have a 80-20 split with our investors. We don't have a pref return because I understand, hey, we have a target return of 5% per year, or 15% internal rate of return. Because of the type of deals we're looking at, we're like, hey, we can double our equity on the resale or refinance or whatever it is that we're going to do. We know we're going to hit that based on our target income per year. So it's a little different, but I stick to that model. It just makes sense. It's already proven for me. It's been an investment thesis that we've worked on for a while. As long as we can put a down payment down, we know we're going to get to 5% per year on that hold. On a 7-year hold, usually shorter. I tend to refinance between 3 to 5 years and pay my investors their capital back. And then we stay in the deal and then we resell it after that last term. Or know what I know now, we'd have just refinanced again and kept those deals, pulled out more money, still been a non-taxable event, and just kept them floating. But to your point, yes, that's how those guys are getting returns. And then even the people who get in low, let's say you get in and you buy a 4.5 cap deal. You got to go in with the intentions of, hey, this deal's a good deal. We can do the minimal here, raise rent, stabilize it, and we're going to turn around and refinance based on that cap rate, right? So, 5 cap, and I won't run the numbers. I won't burn time on the show, but you figure on a 4.5 to a 5 cap deal, my target is always, can we bump rent $600 in this property over a 7-year period? And that's happened a lot faster for a lot of different people, depending on the market you're in. But that's a realistic thing. Like if I think this location will warrant another $600 more in rent over the next 7 years at this cap rate, 5% cap rate, I know we're going to make our down payment back. We'll probably double our down payment, right? What we have in it, we'll make that on the back end and we'll get paid to wait, while we continue to push rents to that level. And if we can do it fast, we'll do it fast. If it takes a longer time to do that, we have the time to do it. Because in multifamily, I'm sure your listeners know, and you've seen it too, it isn't like a house where you paint it, you do whatever to it, and then you stick somebody in there, and in 12 months you may sell. Sometimes with multifamily, it costs you to get out early if your plan is not in place. So a lot of your returns are built on this middle ground, long-term investment that makes sense for your investors.
Yeah. And again, kind of to the comparison of the market here, the last 10 years versus the last year and kind of in the near future, are you seeing that, or are you underwriting for longer hold times than what you were previously?
No, I think the horizon of 7 years is about right, because that's been my experience. The lender is going to be like, your debt's probably going to be 3 years minimum. You might have like 3 years interest only, and then it'll switch over to, principal and interest for the next 2 or something. But there's still a horizon that we have to target. A lot of guys who are like, hey, I got multifamily, they're typically doing like short-term debt, and then they'll refinance it into long-term debt. So there's still, like you said, the understanding when people understand that the debt really controls the optionality to sell or not. So when you get your financing, like if you go, I'm going to get a 3-year interest only on this apartment building. Well, you maybe have prepayment penalties or, defeasance or yield maintenance or something in there. If you try to get anything and sell out early, it may cost you more to sell and eat away at your profit. And depending on what state you're in, your taxes may do that as well. So all of these things have to be brought into account when I look at a deal. I'm like, all right, can we stay in this deal for 7 years? And let's say 7 years hit and we're in another market correction. Can we maintain and keep these deals? Can we say, look, you know what, we'll just hold on to it. We'll wait. That's the long game. I think that's missed a lot. Everyone's, it's like fast money. The days of fast money is over.
Yeah.
There's still money available, but that doesn't mean that, that game is going to always be able to be accessible.
Yeah, it's kind of weird. I recognize that there's a lot of capital looking for deployment, but it's kind of cautious capital. It's not, the easy capital that debt's been pretty easy up till now, or the last 6 months or so.
Yeah.
So, the fundamentals of the housing market, do you see any changes as far as like demand? I mean, or, affordability as far as like, the alternative is, uh, you know, people instead of renting, they buy. I don't see that changing. In at least in most of the markets that, you know, are in demand where there's jobs and there's, people are moving to. I mean, the states or the areas that you've mentioned, um, I would characterize as kind of high demand.
Mhm.
How do you see any, the indicators or any of the characteristics changing that um, make it less of a bright future for real estate, especially multifamily?
No, I think the multifamily is always going to be the belle of the ball. I think people have caught on to the fact that, hey, look, this is fine. Even institutional investors and foreign capital and stuff like that is kind of pushing into the United States or access to multifamily. As it relates to, the base homeowner, it's like, this is something that's, there's what, 80 million baby boomers and, 76 million millennials, and they're all rushing into rentals. Like the rent by choice. You have people with money renting now, as opposed to, my parents and probably your parents too. It was like that wasn't the way. It was like, hey, you own your home, you buy a home, it's a little piece of your own thing. And now that's, people want flexibility. Um, and do you want to cut your own grass? Do you want to, fix your own roof? You want a swimming pool, you want a gym, you want the amenities that you would normally get in a resort, and people are willing to pay for that. Um, I see that a lot. I mean, we moved here, we rent. I've always rented beachfront homes, oceanfront properties, and then when we lived there for years and we're like, you know what, I think we're ready to move on to a bigger place or a nicer place or a different place. It allows somebody who has capital the flexibility. So, and you couple that up with people trying to buy a home, depending on the scenario, 20% down on houses that used to be 600,000, now they're 800,000, $1 million, 200 grand that has to go into that. And, now your rate's 6%, 6.5, 7, on that 800,000, let's just say 5,600 to 6,000 a month. Or you can rent in the same zip code, really nice apartment, 2-bedroom, swimming pool, jacuzzi, fitness center for 4,000 or 3,000 or whatever, wherever people are. That those are people's new choices that weren't available. And as people, especially after COVID, people work remote. So that became this new thing to be like, hey, I don't want to deal with this. I think real estate investors have scared people enough talking about the crash of 08 and 09, to whereas the younger people have heard that online, social media, stuff like that, to whereas they're like, yeah, I'm not going to go through that. I remember the frustration of that. They didn't know what it was like me, but they remember the time that people were struggling through stuff and they've seen it and they're like, yeah, I'm just going to make a lot of money, live where I want, travel, do what makes sense. So I think that's really what's driving everyone. And we are going to become a renter nation. It's already happening. Lyft, Uber, Grubhub, it's no different from where we live. So that's a part of it. And people who take advantage of that opportunity to, take on with that renter wave that's going to continue to happen for my kids, grandkids, things like that, they'll be fine in the real estate industry. So I think that's really where things are.
So, what are your thoughts with the recession talk? Um, we're definitely, we've got higher interest rates. You've already commented that there's a gap between the buyers and sellers. And you're kind of if I'm reading you right, that you're kind of in a wait, or you're raising capital, but you're kind of waiting for the opportunities. What are your thoughts on looking forward and with respects to any kind of recession? Do you think we'll be able to avoid a recession, or do you think that that's uh, just a foregone conclusion?
I think we're in one now. I really do. I think that's already happening. I think it's hit everybody, but I think because there's so much information out there, it's like, when you're inside the mayonnaise jar, you can't see the label. So I think there's so much information about it coming. on all the social medias by people who are kind of pushing that idea, that people are missing the fact that prices are already up, people are already not spending, jobs are already cutting back, people already, aren't making the money that they thought. It's already here. So, I mean, my thing is always like, hey, look, if you have a business, you need to focus on making more money. If you have real estate, you need to focus on acquiring more assets. If you have a capital company to acquire assets, you need to focus on raising more capital. You need to go ahead and stay active in the world to whereas those things don't hit you. We call it create your own economy. So that way, it doesn't matter what the outside economy is doing for you, but for you and your family, you can continue on, by building your own, building your own audience, having your own people and servicing that community. So you make your community better, within your own business and investments, while taking care of those things. So yeah, we're already in that recession, but I think the smart people have already saw that and was like, hey, we're going to do something about it. And the other people are kind of looking at it like, how do we prepare ourselves and pack enough food away so when it hits, we'll be okay. But that wave has already crashed on them. And that's usually how this works. And I'm sure, back facing, we look back and go, man, I wish I would have done more stuff. I didn't know that was happening. And then later, when you come out of it and everyone else is winning, and then that starts the next level of chasing yield, chasing deals. Like, dude, you missed it.
Yeah. Yeah, there's definitely like the mayonnaise jar thing. When you're in it, it's hard to see it. It's more of a hindsight kind of a thing. I'm kind of curious. I mean, the last the '08 thing was kind of a debt crisis.
It was.
Capital just went away. While interest rates have crept up, I'm still hearing about deals getting done, but they're not as many being done, and clearly there's that standoff between the buyers and the sellers. But you're not hearing about you are hearing about some tech layoffs, kind of thing. But prices, the groceries are up, the gas is up, the energy is up, interest rates are up. I'm just kind of curious, if you look back past 20 years, go back 30 years, and when interest rates were higher, and that was kind of the standard. Do you have any sense that this could be the new normal?
Not on commercial, maybe like some of the residential. I look at it like the gas prices. There's no reason to lower the gas prices. Everyone's already used to paying $4 or $5 for gas. So, if people stop complaining, we know it exists. So I think it's that. I remember doing deals back in the 90s and stuff like that, early 2000s. And if I had to pay 12%, 11%, 10%, I was happy to get it. We have a mindset that, the money I can get you is the cheapest money on the planet. So, if it's, and I think people, if you weren't doing deals back then, you didn't get it. That's why people, I call it 7.5, like, good, let's go. So those deals are still happening when you have someone who has the experience enough to say, look, the rate is only a part of this business. So if the rate's a little bit higher, like we said, for multifamily, smaller multifamily, that makes it a little bit tougher because, that rate affects how much cash flow you're getting, and how much cash flow you get is indicative to whether the lender is going to give you that money. But let's say it's some value add deal. Like we, for example, we did a hard money loan, which was, I can't remember the rate. It was like 15%. It was ridiculous. We rolled in the first year. We had to go and release the property because we had a tenant move out, and it was a nightmare. But we turned around and, we had to get out of that property, do some negotiation back with the financing, negotiate away a second debt that was also a high rate. But we still made money on the deal because I knew what I was doing. So to your point, yeah, you do have that. You have that high cost. You have the rates and stuff like that. Will it become a normal environment? It actually has always been the same environment. What we just experienced was actually not a normal environment. Rates would never been that low. And, but to that point, though, to your point, a lot of money got made during that time, so they can forego, the tech guys went in and borrowed a bunch of money, or they raised funds for those things. So they've already prepared for these moments that they have a war chest off to the side to say, look, we're going to lay off non-essentials. We're going to keep it moving with the development of what we're doing because we have a multi-billion-dollar horizon on this evaluation on this company. So it seems like to the outsider, the middle class, people who are like, man, like it's tough out there, but everyone else has already built that war chest through the low cost of capital. And the people who know what they're doing are like, look, I can play in both markets. I can. So to answer that, it's a loaded answer, but it kind of trying to hit all points of that. So that way people listening are like, that makes sense. I know what I'm doing when in the high interest rate. I know we made a lot of money in the low interest rate. So this is the new adjustment, but that game is still being played. So this will give everybody the opportunity to kind of learn that one as well if they didn't experience it in the past.
Yeah. No, it is interesting with a little look of history,
Yeah.
kind of a little look back. What would you recommend the listeners be looking for right now, given the current environment?
A higher quality of asset. If you're going to invest, look for, it's already hard enough to get. It doesn't make, usually what happens is the cost of capital goes up. People look at lower level properties and say, oh, I'm going to buy this, D property in the worst area because this is the one I think I can fix and make the most money on. And it de-risks me. Well, actually it adds more risk. So right now, I think people should go to better class of asset, maybe a little bit higher price, and look for partners and say, hey, look, let's go ahead and let's collaborate on these assets, get a better class of assets. We can ride the wave out on a better ship. And then that way, when it's time to sell, we sell. Someone will still want it rather than get an asset or invest in a deal that's not in the best area. You think you're going to get a high return. It's a management nightmare. And when it comes time to get rid of it, you actually lose versus actually sell because you have less people interested in that when the money comes back and it's cheaper. So that's what I would tell people, is just like, go after better stuff and do it.
Yeah, amen to that. Victor is preaching the truth there. I mean, that is, I've had both ends of that, where I've had a lesser quality and a higher quality, and the lesson I've learned is always high quality is always going to be in demand, and any market, and that kind of speaks to even like cap rates. If you look in like some of your major metro areas where you've got these A class properties, and they trade at these ridiculously low cap rates. The reason is because there's always, that you can always sell that property. Whereas if you go out in the Tules and buy something that's kind of in rough shape, but it's it trades at a 10 cap or something like that, I always tell people, well, I hope you love that, because that may be yours forever. You may not be able to find someone to buy it. So
yeah,
it's good. Hey, Victor, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if we can avoid the risk. And if we can't avoid it, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle.
Yes.
And as such, I like to ask my guest if they can look at their own situation and frame it however you would like. Could be your clients, investors, interest rates, the market, the political environment, pending war, however you would like to identify and declare what you consider to be the biggest risk.
Okay.
And again, for clarification, while I am an insurance broker, I am not necessarily looking for an insurance related answer.
Okay.
And so if you're willing, I'd like to ask you, Victor Bell, what is the biggest risk?
Well, if I can give an honest answer, it's short, is not taking risk at all. Because it's real. I'm a real estate guy. So I take a look at all risk and try to assess it. It was like, hey, how can we minimize risk and get the max return? Even if to other people that return is not that very big. So a prime example, like when I look at an apartment building deal and I really like it, we start sizing the deal up. First thing we do is we look at the debt, we find a debt person, and then I try to get an insurance person on the team to say, hey, what do you think the insurance needs to be here? Could you give me an idea and a quote and a range? Because I recognize like, hey, there's 2 things that are going to happen. And the most important thing to me is to make sure that I de-risk my opportunities by saying, hey, this is a nicer thing, but we have insurance. We have somebody that can take a look at this and say, hey, Vic, this is risky, or this is, this is the cost, this is what you're looking at, and here's why. So I think the quality of asset going up, like we said, is the best way to de-risk, because it removes some of the question long-term and short-term, and have somebody on your team that is in, like, for guys like yourself. And it isn't an insurance thing, it's just real for me. I want to know, like, I don't gamble. When I go to Vegas, I go for conferences. I don't step one foot and play a slot machine. I don't do any of that stuff. So it isn't that I'm not aware of risk, but if you don't take any risk whatsoever, that's a loss. And then you also need to mitigate that risk by having people on your team who understand risk assessment, guys like yourself. And that's an honest answer. Even when I call the bank, I'm like, hey, what can go wrong here, guys? And then they'll tell me, or someone on my team, or a broker. Like I'm all about having people around me that can point out my flaws, because I have them like any other investor. Bright-eyed, bushy-tailed, and I want. So I hope that answers the question. And it's not, may not be what everyone else looks at, but I'm always asking that same question. Like if I don't take a risk, there's a major risk in itself. But if I do take this risk, what does that mean for me and my investors? And who could I get to point out the things that specialize in that I may not even consider? Even if it's cost, like, hey, Vic, the insurance per door on this thing's gonna range you rough about $800, as opposed to you underwrote it and budgeted around about $450. That matters. And I'm like, oh, why? Well, the panel boxes need to be changed out. This needs to be done. Like all the things that most people just take a look at things and don't think about. But that's how I see risk. Take it, but understand the risk you're taking and why.
No, wise words. And to your point, if you don't take risk and you play it safe, you'll never have any growth, or you'll be losing money. So you gotta do something to get in the game and grow your equity and grow your money there. So
Yeah.
that's good stuff. Hey, Victor, where can the listeners go if they'd like to learn more or connect with you?
Google. They can Google Victor Bell. They can go to bell-capital.com. That's our website. You got to be accredited to invest with us, but we would love to answer any questions that you have about what we're doing, how you can be involved. You can go to Facebook, Victor Bell. That's my fan page. You can go to Victor Bell Jr.'s personal Instagram at therealvictorbell.com, Twitter, Victor Bell 365. So LinkedIn as well, Victor Bell or Bell Capital. So I'm YouTube, I'm everywhere. So, and thanks for having me on shows like this. This show is very important. People need this. I wish I had this when I started. It was information that you're taking the time to bring people on to have their conversation started, ask questions, share how they got into the business. It would have shaved probably 10 years off of a lot of learning curves that I probably didn't need to experience. So, that's how to get in contact with me. And also wanted to kind of say thank you for having me and doing what you're doing. It does matter. So I appreciate it.
Yeah, well, I appreciate that, Victor. Thank you very much.
For sure.
Well, again, thanks for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Me too. Thanks so much for having me. I really had a great time.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.